welcome to the research desk. Imagine for a moment sitting in the central boardroom of the Federal Reserve today. The heavy doors are closed, the screens are glowing, and you are trapped in an absolutely impossible contradiction.
It really is the ultimate central banking nightmare, isn't it? The classic stagflation trap.
It is, because on the monitor to your left, you see crude oil has just violently breached $107 a barrel. It is sending these massive waves of inflationary panic through the entire global supply chain. But then, on the monitor to your right, you see the United States economy has just bled 92,000 jobs in a single month.
Right, arriving at the exact moment the domestic labor market begins to fracture. So the core tension is, what do you do?
Exactly. What does the Fed do when inflation rises exogenously, driven by oil, while the labor engine is stalling? I will be arguing the bull case today. The Federal Reserve must cut rates into this oil-driven inflation shock. They have to do this to prevent turning a manageable cyclical slowdown into a catastrophic recession.
And I will be taking the bear case. The Fed absolutely must hold rates high into this weakening labor market. Because cutting right now, it risks validating a completely new structural inflation regime. Capitulating to a softening labor market while supply shocks are actively rewiring the global economy, well, that is the ultimate policy error.
We are going to stress test both of those positions. But first, let us lay out the baseline data before we diverge into the policy implications, because the facts of the current environment are unquestionable. They demand some really deep examination.
I agree. If you are managing a portfolio right now, or even just trying to understand where the business cycle is heading, you have to look at the specific March data points. They are jarring.
They are. So let's start with the policy rate. The Federal Reserve held the benchmark interest rate at 3.50% to 3.75% in March, and they did this by an overwhelming 11-to-1 vote.
That near unanimous consensus is critical. It is not just a footnote. It communicates an ironclad commitment to the market, and consequently, forward curves have almost fully priced out any rate cuts for the entirety of 2026.
Let us explain what pricing out actually means for the real economy, because it is brutal. It means that corporate treasurers who are looking to refinance debt in the next 2 years, they are mathematically accepting that the cost of capital is not going to save them. The relief valve is essentially welded shut.
Welded shut is a good way to put it. And they are facing that high cost of capital while the foundation is rotting beneath them. Look at the labor market. We saw 92,000 jobs lost in February alone.
And the headline unemployment rate has risen to 4.4%, but here is the part that I think is truly alarming. We have now experienced 6 straight months of zero net job creation.
6 months. That is not a statistical anomaly. It is not some data collection error at the Bureau of Labor Statistics.
No, it is a clear declaration. When you have zero net job creation for half a year, restrictive monetary policy is clearly suffocating the credit channels, the exact channels that small and medium-sized businesses rely on just to make payroll.
But simultaneously, we are getting hit with this aggressive supply shock. Brent crude is trading above $107 per barrel. And this specific energy spike is driving headline inflation projections up to around 2.7%.
So we literally have a stalling labor engine crashing headfirst into an exogenous commodity price spike. It is the textbook definition of stagflation.
We absolutely agree on the severity of the labor weakness, and we agree on the magnitude of the oil shock. But there is a third pillar of agreement here that is arguably more dangerous than the other two combined.
You were talking about the financial plumbing?
Yes, the severe deterioration of our financial plumbing. We are currently watching global bond markets lose roughly $2.5 trillion in the recent Iran war sell-off.
Wait, let me stop you there. $2.5 trillion just in the recent geopolitical sell-off?
Exactly. I want to pause and emphasize the scale of that capital destruction because it immediately echoes the brutal bond math we all suffered through in 2022. It is an absolute bloodbath in sovereign debt.
And it is not just the aggregate dollar loss that matters there, right? It is the microstructure of the market itself.
Precisely. We are seeing Treasury liquidity thinning to incredibly dangerous levels. The order books are hollowing out. They are exhibiting clear, undeniable signs of forced selling.
Furthermore, the data coming out of the New York Fed suggests that United States credit markets became demonstrably more dysfunctional throughout March. We really have to remember that monetary policy does not act on a theoretical spreadsheet inside the Eccles building.
No, it acts strictly through these very markets. It relies entirely on the smooth functioning of collateral and liquidity.
So what actually happened? Think about this for a second. We just witnessed $2.5 trillion in bond value completely evaporate in a matter of weeks.
Right. That is collateral physically vanishing from the global financial system.
Exactly. To understand why this matters, you have to look at how credit is actually created. Regional banks, pension funds, major financial institutions, they hold these bonds as Tier 1 capital. It is the bedrock of their balance sheets.
And when the value of that bedrock drops by $2.5 trillion globally, those banks are suddenly pushed right up against their regulatory capital requirements.
Mathematically, they cannot extend new loans. So the mid-sized manufacturing firm in Ohio gets its credit line pulled. They cancel their planned expansion, and they fire their contractors. The lifeblood of the economy coagulates.
Which is a terrifying dynamic. But I know you are going to use this to justify an immediate pivot.
I am. This brings me directly to why the Federal Reserve must initiate insurance cuts before the labor market completely breaks. The Fed is aggressively fighting the wrong inflation.
The wrong inflation? How can you look at $107 oil and say it is the wrong inflation?
Because when we strip out the exogenous shocks, when we actively remove the volatile energy sector and the immediate war premiums, underlying core inflation is sitting much nearer to 2.3%. The current surge pushing the headline projection to 2.7% is entirely driven by oil and war risk.
But consumers pay for oil. They don't live in a core inflation world.
They do, but let us talk about the neutral rate, or R star, the theoretical interest rate that neither stimulates nor restricts the economy. If the underlying inflation run rate is genuinely 2.3%, then maintaining a policy rate of 3.50% to 3.75% means the Fed is operating approximately 100 basis points too tight relative to neutral.
That assumes the 2.3% core run rate will hold steady while energy costs skyrocket, which I completely disagree with.
Maintaining a deeply restrictive stance into a geopolitical supply shock does not cure the shock. That is the fundamental disconnect I am trying to highlight. High interest rates do not pump more crude out of the Permian Basin.
Obviously not.
They do not magically reopen contested shipping lanes in the Middle East, and they certainly do not de-escalate regional ground wars. All they do is maliciously crush domestic demand. They force companies to fire workers, while gasoline and freight costs inflict their damage regardless of what the Fed does.
Okay, but the central presumption in your thesis is that this supply shock is a purely transient cyclical phenomenon. You are assuming the global economy will neatly digest this oil spike, naturally normalize over a few quarters, and thereby allow the Federal Reserve to pivot its focus entirely to the domestic labor softening.
I am assuming the free market works, yes.
But that profoundly ignores the reality of how these specific types of shocks embed themselves deeply into the psychology of price setting. When you have energy driving up the cost of every single logistical touchpoint in the supply chain, businesses do not just absorb the margin hit and wait for peace treaties.
They adjust, yes.
They pass the costs on. And more importantly, they adjust their baseline expectations for future costs. That is how a one-time shock becomes a structural trend.
They embed themselves only if we assume global supply is static and incapable of reaction, which the entire history of modern capitalism proves it is not. Let me offer a direct, recent parallel to prove exactly how supply shocks trigger rapid, aggressive adaptation.
You are going to bring up the pandemic, aren't you?
I am going to bring up the semiconductor shortage of 2020 and 2021, specifically, because this is the perfect case study. When the pandemic hit and demand for consumer electronics exploded while supply chains locked down, what initially looked like a multi-year structural bottleneck completely froze global auto output.
I remember. You had major car manufacturers shutting down entire assembly lines.
Entire lines shut down because they could not source a 50-cent silicon chip. Policymakers and industry leaders panicked. The consensus narrative at the time was that we were facing a permanent era of chip scarcity that would chronically constrain growth and drive up prices for a decade.
which, to be fair, was a highly rational fear given the geopolitical concentration of fabs at the time.
Irrational fear? Maybe, but look at the actual numbers and the timeline of how the market responded. Within 18 to 24 months, major producers, specifically TSMC and Samsung, accelerated massive, unprecedented capital investments.
They had to. The financial incentives were astronomical.
Exactly. They didn't just wait for the Fed to fix demand. They retooled their production lines, they optimized their existing capacity utilizing advanced software allocations, and they poured billions of dollars into breaking ground on new fabrication facilities.
But that took years to fully come online.
The result was textbook economics. Output expanded rapidly, and the worst of the shortages eased much faster than anyone in Washington feared. Price signals actually work. When a commodity or a critical component spikes in price, the market adapts because there's a massive financial incentive to solve the bottleneck.
I don't disagree that price signals work, but the nature of the adaptation has changed.
Companies reroute their supply chains, consumers temporarily retrench to alternative goods, and producers overinvest to capture the premium pricing. If policymakers at the Fed treat every war-induced commodity spike as the genesis of a permanent 1970s-style inflation regime, they will mistakenly lock monetary policy into a severely recessionary posture at the exact moment the supply shock is naturally beginning to normalize through market forces.
You are looking at this in isolation.
We have to look beyond our own borders. We do not exist in a vacuum. Look at the global spillovers happening right now. Germany's industrial and business outlook is rapidly deteriorating as their export-driven model collapses under energy costs.
Germany is in an incredibly tough spot. Yes.
In the United Kingdom, inflation is stubbornly stuck at 3%, which completely limits the Bank of England's policy flexibility. It is trapping them in stagflation. South Africa is being forced to hold rates steady despite massive domestic economic strain.
And the ECB?
The European Central Bank is actively warning the markets that they could be forced to hike if price pressures worsen. The global economy is slowing down synchronously. The United States simply does not need to add severe domestic restriction to a global growth shock that is already in full swing.
That is a compelling argument. I will give you that. But have you considered that energy today isn't just a cyclical commodity? It is a strategic weapon.
A weapon? That is a very dark way to look at oil markets.
It is the realistic way to look at them. You were analyzing this entire landscape through the lens of a world that existed roughly from 1990 to 2019. That was a world optimized purely for economic efficiency, for perfectly synchronized just-in-time delivery, and for completely frictionless global trade under a single hegemonic security umbrella.
And you believe that world is completely gone?
We have fundamentally exited that paradigm. We are entering a structurally poorer, more inflationary world. Cutting interest rates into this new environment repeats the central, devastating era of the 1970s.
I think comparing today's labor dynamics to the 1970s is quite a stretch.
Let me explain why it isn't. The global economy has stopped optimizing for efficiency and has aggressively begun optimizing for resilience. This means friendshoring. It means building highly redundant, overlapping supply chains. It means deliberately constructing domestic strategic capacity, completely regardless of the cost.
Which creates jobs domestically.
Yes, but every single step of that deglobalization process is inherently structurally inflationary. You use the semiconductor example to prove that supply catches up. But let us look deeply at how that semiconductor supply is actually being built today, because it proves my point, not yours.
How does adding capacity prove we are structurally poor?
Consider the United States CHIPS Act. The federal government is committing $52.7 billion to incentivize domestic fabrication capacity. Now, from a national security perspective, from the perspective of securing critical infrastructure against geopolitical blackmail, this is a highly rational, necessary strategic maneuver.
Right. It secures the supply chain.
But from an economic and macroeconomic perspective, it is profoundly disinflation unfriendly. Let us unpack why. Building a massive new fabrication plant in the Arizona desert or in Germany does not miraculously replicate the immense, hyper-efficient scale of Taiwan.
It is more expensive initially. Yes.
It does not replicate the deeply specialized, multi-generational labor ecosystem that exists in Asia, and it certainly does not replicate the brutally low cost structure. When you build a fab in Arizona, you are dealing with immense regulatory friction, exponentially higher labor costs, strict union requirements, and a fractured secondary supply chain that has to ship components across the Pacific anyway.
You are focusing entirely on the startup costs.
I am focusing on the unit economics. We are making a deliberate societal choice to trade higher unit costs for lower geopolitical vulnerability. That is the definition of a poorer, structurally inflationary world. That guarantees that inflation will remain sticky, even when domestic consumer demand softens.
I am not ignoring the logistical friction and the capital costs of friendshoring. I understand that moving a supply chain from Shenzhen to Phoenix is expensive, but to suggest that this transition permanently elevates inflation to a degree that requires the Federal Reserve to blindly hold rates at 3.75% while the labor market is bleeding 92,000 jobs a month is entirely disproportionate.
It is not disproportionate if you understand how inflation expectations anchor.
We have to separate a one-time price level adjustment from structural, compounding inflation. The price level adjusts once to the new, higher cost structure of domestic manufacturing. It does not perpetually inflate year after year at 5%.
That assumes wages don't chase the new price level.
Furthermore, aren't you completely ignoring the deflationary counterforce of technology? You say a fab in Arizona costs more in labor, but doesn't the massive acceleration in AI-driven automation, robotics, and software optimization offset those labor cost differences over a multi-year horizon?
It perpetually inflates if the central bank validates the initial price shock by cutting rates prematurely, which brings me to the ultimate cautionary tale of the 1970s stagflation trap. This is the history we simply cannot repeat.
We are not in the 1970s. Union density is a fraction of what it was.
The mechanics of expectation are exactly the same. After the initial 1974 oil embargo shock, the United States economy was hit by a poisonous, highly complex combination of surging energy prices and rapidly weakening economic activity.
Right, Arthur Burns was running the Fed at the time.
Yes, Arthur Burns. And policymakers looked at the weakening industrial activity and the rising unemployment, and they decided to relax policy. They treated the energy shock exactly as you are suggesting we treat this one.
I am suggesting we recognize it as an exogenous event.
Exactly. They treated it as an exogenous event, a temporary geopolitical disruption that the vast American economic system could simply absorb over time. They explicitly hoped that inflation would naturally fade as economic growth slowed down.
And initially, growth did slow significantly.
But inflation didn't fade. Because they cut rates, they signaled to the market that the Fed would not defend the currency's purchasing power. They validated the higher price level. Once you do that, the energy shock bleeds directly into the broader economy.
You are talking about the wage price spiral.
Exactly. Workers see their grocery and gas bills spike, so labor unions demand massive cost of living adjustments. Businesses see their raw materials spike, so they preemptively raise the prices of their end services. It creates a self-fulfilling psychological loop.
But again, union participation today is nowhere near the 1970s levels.
It doesn't matter, the psychological loop is the same. Look at the numbers from that era. By 1979, the consumer price index had hit a staggering 13.3%. And yet unemployment was still elevated, stuck chronically around 6% to 7%.
The misery index was incredibly high, yes.
By 1980, the CPI was above 14%. Think about that, 14% inflation while people are out of work. The supposed kindness of easing policy early to save the labor market merely postponed the economic pain and magnified it exponentially.
Which ultimately forced Volcker's hand.
It required Paul Volcker to step in and drive the federal funds rate to near 20% in 1981. He deliberately induced a brutal, deep recession just to finally break the back of that entrenched inflation psychology.
Pushing rates to near 20% today would bankrupt the federal government in a week.
Which is exactly why we cannot let inflation expectations unmoor right now.
When a central bank loses credibility on inflation, the ultimate cost of regaining it is catastrophic. And regarding your immediate concerns about growth collapsing today, the underlying data simply does not support this level of panic.
How does 92,000 lost jobs not support panic?
Let's look at institutional modeling. Goldman Sachs still projects 2.1% United States gross domestic product growth for the entirety of 2026.
That is a baseline projection.
Even when you look at their severely adverse scenario, their absolute stress test for the economy, the downside only goes to 1.8% growth. Yes, an unemployment rate of 4.4% is higher than the absolute cycle low we enjoyed a few years ago, but 4.4% is not historically recessionary. It is a normalization.
So you are saying we should just tolerate the job losses?
I am saying cutting rates right now, in the face of sticky structural changes, is a profound policy error driven entirely by fear, not by macroeconomic necessity.
I understand the fear of repeating the 1970s. I really do. But we have to look at the asymmetry of risk in the present moment. If we stubbornly hold rates at these highly restrictive levels to fight a phantom 1970s wage price spiral, and the modern credit system fundamentally breaks under the pressure, isn't that worse?
You think a credit break is worse than 14% inflation?
Yes, because the resulting financial crisis would be dramatically worse than tolerating slightly higher energy-driven inflation for a few more quarters. We're analyzing the situation as if the financial plumbing is an indestructible monolith that can withstand 3.75% indefinitely.
It is strained. I admitted that.
But the $2.5 trillion global bond drawdown you yourself brought up proves it is not just strained, it is cracking. Policy is currently being pushed through a broken pipe.
The broken pipe analogy is vital here. We need to really explain how this mechanism works for the listeners.
Go ahead. How do you see the broken pipe?
In a macroeconomic textbook, a central bank raises or cuts the policy rate, and financial conditions adjust smoothly and proportionately across the entire yield curve. The textbook assumes a frictionless transmission.
Which is a complete fantasy in today's market.
Exactly. In reality, the financial system is a highly complex, interconnected plumbing grid of primary dealers, clearinghouses, and shadow banking entities. With a massive $2.5 trillion bond drawdown and acute, observable signs of forced selling in the deeply critical treasury market, incredible pressure builds up in unseen corners of this grid.
And that pressure doesn't distribute evenly.
No, it doesn't. It leaks out unpredictably, and eventually it violently bursts where the system is weakest, often in a highly leveraged sector no one is actively monitoring.
Exactly, and we are operating in a landscape of digital financialization that deeply amplifies everything you just described. This is not the 1970s where capital moved through physical paperwork and phone calls.
The speed of money has completely changed.
Information is disseminated globally in milliseconds. We do not have weeks or months to assess a credit crack forming in a regional bank. We have hours.
Reflexivity is a real danger.
This digital reflexivity makes the system incredibly fragile to policy missteps. Look at the 2013 taper tantrum as the perfect historical illustration of the speed and the sheer violence of modern capital flows. Let's walk through exactly what happened, because it proves how delicate the modern system is.
2013 was a communication error more than a policy error, though.
That is exactly my point. The Federal Reserve didn't even tighten policy in 2013. They didn't raise the federal funds rate by a single basis point. They didn't even stop their quantitative easing program.
All Bernanke did was speak.
All that happened was that Fed Chairman Ben Bernanke sat before Congress and merely hinted at the possibility of reducing the pace of bond purchases at some unspecified point in the future. He whispered about normalization.
And the market completely overreacted.
That mere communication, just the hint of a shift in liquidity, triggered massive, immediate capital flight from emerging markets. Yield-starved investors who had flooded into developing economies panicked simultaneously. Indonesia is the classic example here.
The rupiah took a massive hit, yes.
The Indonesian rupiah collapsed more than 20% against the US dollar in a matter of months.
Bond yields surged globally as algorithm models and risk managers dumped emerging market debt to front-run the perceived Fed tightening.
It was a violent repricing.
If a mere handful of policy normalization caused that scale of violent, cascading dislocation in a less fragmented, significantly less indebted world in 2013, the potential spillovers in today's highly digitized, heavily indebted, algorithmically driven system are terrifying.
I don't disagree with the mechanics of your argument.
The transmission channels are deeply asymmetric and globally reflexive. If the pipe bursts today, the speed of the contagion will be something we have never witnessed.
I agree entirely that the broken pipe analogy is mathematically accurate. And I completely agree that digital financialization radically changes the speed of transmission. But this is where our conclusions diverge completely.
How can you agree on the fragility but not the solution?
Because you are using the reality of the broken pipe and the fragility of the system to justify a preemptive rate cut. I see the broken pipe as the exact reason we must be incredibly careful not to destabilize inflation expectations.
Destabilize them by providing liquidity?
By signaling surrender. If capital moves instantly and if algorithms price in reality in milliseconds, then a premature, unjustified rate cut could trigger an immediate, violent repricing of inflation premia across the entire long end of the yield curve.
You think the long end would sell off if the Fed cuts?
Think about the mechanics of this. If the Federal Reserve cuts the short-term rate simply because gasoline temporarily rolls over or the labor market softens, but the underlying sticky price structure of core services, shelter, commercial insurance, and union wages has not actually normalized, they risk validating a permanently higher nominal regime.
The headline inflation is driven by the $107 oil.
The modern version of stagflation is amplified by this exact digital speed you are worried about. Inflation expectations do not take years to build anymore. They jump from commodity futures markets to interest rate swap markets to corporate credit spreads instantly.
So you are saying the bond vigilantes would punish a cut?
Absolutely. If the Fed cuts and the global bond market collectively perceives that the United States Central Bank has surrendered to the new geopolitical cost structure, long-term bond yields could ironically spike. Investors will dump 10-year and 30-year treasuries.
Because they would demand a massive inflation premium?
Exactly. They will demand a massive inflation premium to hold that debt. You could see mortgage rates skyrocket even as the Fed cuts the overnight rate. That would completely crush the housing market and accelerate the very recession you were trying to prevent.
Well, we have thoroughly mapped the macroeconomic danger from both sides at this point. We understand the risk of validating structural inflation, and we deeply understand the risk of a systemic credit break caused by instantaneous capital flight.
It is a phenomenal dilemma.
It is. Now, we need to reach a synthesis on how institutional and retail capital must actually navigate this profoundly complex environment. It is not enough to just diagnose the stagflation trap. We have to build the portfolio to survive it.
I think we are actually quite aligned on the portfolio construction, surprisingly.
I believe we are converging on a framework that we can call conditional restraint. I will acknowledge, looking at the historical data from the 70s, that holding rates steady is safer than cutting prematurely into a truly structural friendshoring inflation regime.
Provided the labor market holds up.
Provided the labor market does not enter a non-linear, cascading collapse.
And I will fully acknowledge that if the financial pipe actually bursts, if we see absolute systemic failure in treasury market liquidity, or if core credit market functioning completely seizes up, then rapid emergency triage cuts become absolutely necessary.
Completely regardless of what the headline inflation print says.
Yes, completely regardless. You cannot fight inflation if the banking system does not exist. The operational mandate for the Federal Reserve must be ordered precisely in this specific hierarchy.
Protect institutional credibility first.
Exactly. Protect institutional credibility first, preserve policy optionality second, and rescue financial markets only if the systemic failure directly threatens the broader macroeconomic mandate.
With that conditional restraint established, we have to methodically walk through the exact portfolio playbook for this specific environment. Every single allocation shift requires a highly specific why tied directly to the mechanics of the stagflation trap we just discussed. Let's start with fixed income, because that is where the most confusion is right now.
Looking at bonds, investors need to add a measured overweight to high-quality intermediate treasuries.
Specifically, you want to target the 6 to 12-month duration range. Let's explain why this is the optimal pocket.
It is the sweet spot on the curve. It is. This allocation acts as pure recession insurance. Because the market is already aggressively priced out virtually all 2026 rate cuts, the yield curve is incredibly taut right now.
Meaning any shock will force a massive repricing.
Exactly. Any sharp, unexpected deterioration in the labor market or a sudden credit event will force the market to rapidly reprice cuts back in. This creates significant capital appreciation upside in these specific 6 to 12-month bonds.
But we are staying away from the long end.
We are explicitly not taking a massive long-duration bet. We are avoiding 20-year or 30-year paper completely. Because as you pointed out, structural inflation is still a massive tail risk that could crush the long end of the curve. But the short to intermediate curve offers incredible, mathematically sound protection right now.
If we apply that same rigorous logic to equities, the focus must immediately shift to defensives. In this environment, you want to overweight healthcare, consumer staples, and utilities by approximately 10% for the next 12 to 18 months.
10% is a significant tilt. Why those sectors specifically?
The reasoning here is entirely based on the mechanics of pricing power. In a sticky cost world characterized by geopolitical fragmentation, redundant supply chains, and structural inflation, corporate margins are under relentless attack.
Input costs are soaring for everyone.
Right. So companies that possess durable free cash flow and the explicit, inelastic ability to pass their rising input costs directly through to the end consumer are going to drastically outperform. People will continue to buy medicine, basic groceries, and electricity regardless of what Brent crude is doing.
It is a fundamental margin defense.
These sectors offer a fundamental margin defense against both inflation and a slowing labor market, which will allow them to survive while long-duration growth and weak margin cyclicals get absolutely dismantled.
Which leads us directly to the necessary stance on growth beta. Portfolios absolutely need to reduce exposure to broad, high-multiple growth indices. We are talking specifically about reducing vehicles like the QQQ by roughly 10% over the next 12 to 18 months.
Cutting the QQQ by 10% is going to be painful for a lot of retail investors who have ridden that tech wave.
It might be painful to execute, but let's explain the mechanics of valuation compression for the listener. When you value a high-growth tech company, you are using a discounted cash flow model. You are projecting massive earnings 10 years into the future and discounting them back to today's value using the current interest rate.
The discount rate is everything.
Discount rate stays elevated, the present value of those far-off future earnings collapses.
And that is valuation compression.
That is valuation compression in a nutshell. It can completely overwhelm and destroy a stock's price even if the underlying company delivers excellent top-line revenue growth. Unless core inflation clearly rolls over and mathematically proves the structural thesis wrong, paying 40 times forward earnings is a severe, unacceptable vulnerability.
On the commodity side of the portfolio, you must maintain an approximate 10% overweight in energy equities and select real assets. We cannot ignore the primary data point here.
You mean the $107 oil?
Yes. Brent crude sitting above $107 is not just macroeconomic trivia for economists to debate. It is a blaring portfolio signal. It directly represents the physical premium of operating in a fragmented, hostile world.
So you buy the producers.
Holding energy producers and physical infrastructure protects the broader portfolio against prolonged geopolitical risk and the harsh reality of energy nationalism. When supply chains break down, physical assets hold their premium.
Conversely, on the other end of the spectrum, you must actively avoid the weakest consumer-exposed sectors. We strongly recommend an underweight position in consumer discretionary equities by about 7% over the next 12 months.
A 7% cut to discretionary makes sense given the labor data.
The economic logic here is brutal, but incredibly simple. When inflation hits, households absorb the non-negotiable costs first. They pay for higher fuel costs at the pump. They pay for higher food costs at the grocery store. And they pay higher financing costs on their credit cards.
There is nothing left for luxury goods.
When you combine those unyielding mandatory expenses with the reality of 6 consecutive months of zero net job creation, The downside risk to discretionary demand is immense. The consumer wallet is simply tapped out. They are not buying the new television or booking the luxury vacation when they are worried about local layoffs and $107 oil.
Finally, while we are positioning defensively for stagflation, portfolios must prepare a highly specific, conditional risk-on pivot. You do not want to be perpetually defensive and miss the eventual recovery.
What is the exact trigger for that pivot?
The trigger to rapidly rotate capital back into innovation and large-cap technology is highly specific and data-dependent. You execute this pivot only if core personal consumption expenditures, the Fed's preferred inflation gauge, falls below 3% for 2 consecutive quarters, occurring alongside deepening labor market weakness.
Below 3% for 2 quarters? That is a high bar.
We need to be clear about why this is the trigger. That specific metric is the exact mathematical condition under which today's highly restrictive monetary policy transitions from being a necessary discipline against inflation to becoming an obvious, undeniable policy error.
Because if inflation is genuinely anchoring below 3%.
Exactly. If core PCE anchors below 3% for half a year while jobs are vanishing, it signals the definitive all clear. The inflation psychology has been broken, the structural fears were overstated, and the Fed will be forced to aggressively cut rates. This will provide massive tailwinds for duration and growth assets.
The trap is not inflation versus recession. The trap is mistaking a poorer world for a temporary slowdown.
The final question every investor must ask themselves tonight is this: is the market truly pricing in the permanent cost of this new geopolitical resilience, or is it secretly still hoping for a miraculous return to the frictionless efficiency of the 2010s?
This is the research desk officially signing off.